Welcome back. Namibia's central bank has once again opted to keep the repo rate unchanged, a move that directly affects borrowers, savers, and of course the wider economy. To help us unpack what this means for households, businesses, and the country's growth outlook, we're joined by Dr. Christopher Shafuda, UNAM Senior Lecturer in the Department of and International Economics. Doctor, good evening. Thank you so much for joining us here on the Daily Roundup.
Good evening, Nina. Thank you.
Well, Dr. Shafuda, what's the main reasoning behind this decision to keep the repo rate the same?
Thank you so much. The main reasons of keeping the repo rate unchanged is just that the inflation rate or the prices has been stable in the economy, and we have seen that for the past few months that the inflation rate has been subdued. And also the other thing is that the credit extension, which actually is the extent to which financial institutions extend credits to firms and private individuals, has been also growing. So that's actually the reason why the repo rate remained unchanged.
Mm-hmm. And what does this translate to for ordinary Namibians, from borrowers with loans to savers in the bank?
What it actually means to an ordinary Namibian is that for the borrowers, that they actually have confidence that to borrow more, not really borrow more, but their borrowing habit won't really change because they know what interest rate they are getting, and to the savers, it's still probably the same thing because their return on saving. But for savings, only if they are saving in the what they call asset or prime rate backed savings. So then their interest return on these savings will pretty much be the same or unchanged. Mm-hmm. So both borrowers and savers, they do not really expect a change on their investment or borrowing habits because obviously the interest rate remains unchanged.
Mm-hmm. Well, Dr. Shafuda, some argue that keeping the rate steady helps economic stability, while others say it could slow growth. So where do you stand on this debate?
On terms of economic growth, we have other factors that actually contribute to the growth of economy. Obviously, monetary policy is one of them. But changing or keeping repo rates has two effects. It can affect the economy negatively in a form of that if interest rates are high, then the consumers will not borrow or purchase, and if they are not borrowing, that means there will be less money circulations in the economy. But also, again, if we are to keep the repo rates too low, then it's likely to harm the economy more because of the impossible trinities that most economists talked about, that you cannot have free capital flows and fixed exchange rate as well as independent monetary policy. So what happened is that because of that fixed exchange monetary policy or fiscal exchange that we have, or the peg that we have to the South African rand, then we expect that if our interests are too low, then we expect that the money will flow out of country toward the South African economy where the interest rates are high, mm-hmm. which is also likely to harm the Namibian economy because the money will then not be invested in Namibia, but rather than be invested outside of Namibia.
Mm-hmm. Well, on that note, Doctor, looking ahead, what indicators should Namibians be watching out for that might trigger future change with the repo rate?
Things that we have have to look at the prices of goods and services. Or obviously, they have been substituted, and if they kept being substituted, we might still have some rooms of maybe reduction in the repo rate. And the other things that we have to look at is also the repo rates changes in South Africa. So if the repo rates decrease in South Africa, then we might also perhaps have some rooms of adjusting our repo rate down in Namibia.
But we have seen South Africa lower their repo rate, I think, in the past, I think twice or thrice, while Namibia has decided to keep ours at the same rate. And given our, economic ties with South Africa, what factors makes our context different?
If we are to follow the South African repo rate here, it has been reducing, but it was also a bit higher compared to the Namibian repo rate. And so the fear is that if we are keeping or reducing our repo rate, is the same thing that I've been talking, or I said earlier, that we are running a risk of having our capitals flowing to the South African economy where the interests are high. But also, if you look at the prime lending rate, the current prime lending rate of Namibia and South Africa are actually equal. And this is because my apology for that. And this is because the interest rate in the split between South Africa and Namibia is different. The split for South Africa is 2.5%, while for Namibia is 3.75%. So if you look at that, in prime rate is actually the same. Although the Bank of Namibia has announced that it's going to reduce the split in the, I think in the next, if it's not in the month of October, I think it's the month of November, with 25 basis. So which also going to relieve the economy, or also encouraging the individuals and firms either to borrow more and pump money in circulation in the economy.
Yeah. Well, Dr. Christopher Shafuda, thank you so much for your time this evening. Thank you for joining us here on the Daily Roundup.
All right, thank you so much for having me. Thank you.
When we come back.